Welcome to this episode of the Profitable Home Services Podcast. This is the podcast where we dig deep into the profit and cash flow leaks in your business. But today, we're going to dig deep into the cash flow leaks that have to do with income tax. As we're recording this session or this episode, it is in the fall, and fall is prime tax planning season. Different home service businesses owners are starting to think about, wonder how much tax I'm going to owe this year. Maybe it's time to do a tax projection. Maybe it's time to make some strategic moves so that I don't owe so much tax. In some of our other episodes, we've talked about how to plan the amount of profit you want for the year. Well, now it's time to talk about how to plan how much tax we want to pay for the year. So join me. I'm going to show a little PowerPoint as I talk about this. If you look right behind my head, you see the book 10 Most Expensive Mistakes That Cost Service Business Owners Thousands. Well, I've pulled an excerpt from that book. It's one of my books, and that's what we're going to talk about today. So give me just a moment here as I share my screen. Okay, as I said previously, we're going to talk about the 10 most expensive tax mistakes that cost home service business owners thousands. And these are some of the most common mistakes I see as I work with clients all across the US. So many accountants take the stance at this time of year that to save money, that all you need to do is run out and buy another truck, run out, buy another van, invest some money in some more equipment. It's those types of strategies that I see them say. And I see them not looking any deeper into the client's books of records and finding other tax saving strategies that could save them a boatload of money. To this date, I have saved my clients more than $13 million in income taxes. That's something I'm very proud of, and something I'd like you to be able to participate in by learning how to do some true tax planning. So our first mistake that we're going to talk about, one I see all the time, is failing to plan. People don't realize that just like in planning how much profit we want in our business, we can set a plan in motion to minimize the amount of tax so that we're only paying the minimal amount of tax that we legally need to pay. And here's just a quote from William Rehnquist, who is a Chief Justice, I believe. It says, "There's nothing wrong with a strategy to avoid the payment of taxes. The Internal Revenue Code doesn't prevent that. In fact, the Internal Revenue Code is filled with different types of deductions that a business owner can take advantage of." All the time I hear the question, well, what's tax planning? Why is tax planning? My accountant does my taxes for me. How come they don't give me any strategies? Well, when you engage an accountant to do your income taxes, you're engaging them to prepare a tax return, to put little numbers in little boxes and get that tax return filed on time. That is what you've asked them to do, and that is what they've done for you. Many times people don't realize that during tax season is the busiest time of year in an accountant's life, and there simply isn't time to stop and come up with strategies. You're tired, you're pushed, you're stressed, and you're just trying to get those tax returns done. That is why this is a time of year that we spend so much time on the tax planning side of things. Tax planning is your key to financial defense. It is where you can make a difference. We can all go out and implement a new marketing plan or new marketing program, but there's no guarantee of how much that's going to increase our top line sales. But we can put a tax saving strategy in place and save hundreds or thousands or multi-thousands dollars worth of tax through legitimate tax savings deductions. So tax planning allows you to be able to guarantee results. My clients hear me say this all the time. I'm always saying you must pay taxes, but there's no law out there that says you have to leave a tip. Before we get into some of the tax saving strategies, I wanted to just do a quick recap of how we calculate total income for purposes of an income tax return. So we're going to pick up earned income, which is your W-2 income, and then your business profits and or losses, any interest or dividends that you've earned for the year, capital gains, pensions, IRA distributions, annuities, any alimony income that you receive, any gambling winnings, and even illegal income. These are all taxable types of income. From that total income number, we're going to subtract some adjustments. If you've contributed to your IRA, your traditional IRA, we're going to have a deduction there. If you're filing in an entity like a sole proprietorship or a single member LLC, you're going to pay some self-employment tax on that income, so we get to deduct one half of it. We might have some self-employed health insurance that is a deduction that falls in this area, and potentially even some student loan interest. Then we get down to taxable income, and from there, we're going to look at whether we should take a standard deduction or itemized deductions. Most people nowadays end up taking standard deduction, though I do have a fair share of clients who still itemize. Standard deduction has been increasing at a decent rate over the years. So you'll notice that the first up to $13,850 is our standard deduction this year. So that means anybody with income less than that pays zero amount of tax. Remember that when we get down the road and we start talking about family employment. If you're married, that number is $27,700. So a lot of my seniors no longer have to file tax returns because their total income is less than that. When we compare that over to itemized deductions, there we are able to potentially pick up some medical or dental expenses of state and local income taxes. So that is limited to $10,000 currently. Maybe some foreign taxes that were paid, some interest like your mortgage interest for your home or maybe even a second home, possibly some casualty or theft losses. We don't see that one very often, but occasionally. And then your charitable contributions or gifts. We're going to add all those numbers up, and then we're going to take the higher of the two amounts. And then that is what we end up deducting. Just wanted to give you a quick rundown on tax brackets. Up to $11,000 or from $11,000 on, we're at the 10% tax bracket or $22,000 for a joint tax return. And our tax rates go from 10,000 or from 10% up to 12%, then 22%, 24%, 32%, 35%, and our top bracket currently is at 37%. You can see those numbers start growing pretty big at 32%. You're going to get all the way up to $231,000 on a single person or $462,500 on joint. These brackets are less than what they were a few years ago, and so that has been a good thing. Once we've determined the tax that's owed, then we're going to look at, do we have any tax credits? I want to back up a moment and talk about the difference between deductions versus credits. Tax deductions come off at a percentage of a dollar. So let's just say you're at the 25% bracket, just because that's easy math, and we have $100 worth of deductions. So we'd multiply that $100 times 0.25, and we would end up with $25 savings in income tax. Now, if we were in tax credits and we had $100 of tax credits, we would end up with $100 of tax credits being subtracted against the tax that we owed. So credits are way more valuable than deductions are. But wait, there's more. You hear this quite often on TV. There are more taxes that we need to potentially think about. If you're a sole proprietor or a single member LLC, or even a partnership, we may have some self-employment tax that needs to get calculated. We may have some net investment income tax that also needs to be calculated, or even some alternative minimum tax or the nanny tax. So your federal income tax is not where it ends. It's kind of where it begins. And then we may need to add these other taxes on as well. There's 4 different ways that we traditionally save taxes or cut taxes. The first one is timing and how we recognize the various income and expenses. The next area that we talk about, or the bucket that we talk about, is shifting money from maybe one year to the next, or shifting from yourself down to a family member who's in a lower tax bracket, those types of things. Then we have the deductions that fall within the actual tax code itself. Those sit in a bucket. And then our last bucket is products that allow you to receive deductions because they're tax favorable products. Those are just some of the ways that we can cut some taxes. So our second most expensive mistake that I see is centered around audit paranoia. There's a group of people that I see on a somewhat regular basis that are just scared to death that they're going to be audited. And so they are so ultra conservative that they often overlook various expenses that are legitimate expenses for the type of business that they run. So I just wanted to bring in some audit rates for you. If you'll notice on Schedule C, from 25,000 up to about 100,000, we're running about 2% for audit rates, as well as over 100,000, pretty close to 2%. But if we're looking at a partnership or an S Corp entity, that rate drops down to about 0.5% of people actually get audited. So audit rates have been traditionally low, especially as we've been coming through the last couple of years of COVID. I do anticipate that they will start picking up as the IRS has hired some additional agents. Our third mistake that I want to talk about today is operating your business within a wrong business entity type. I see this one fairly regularly, and it can cause people thousands and thousands of dollars in overpaid taxes. I want to start out that when most people start up their business, they pretty much start out as a proprietorship or maybe a single member LLC. When you are in that entity type, 100% of your business profit is reported on Schedule C on your personal income tax return. You pay income tax on that net income or on the profit of your business, but you also pay self-employment tax on that income, and that self-employment tax rate is 15.3%. That can be a big bite when you've already paid income tax on that same piece of income. If we look at a business with a net profit of $80,000, that self-employment tax is $11,304. When you subtract that from your $80,000 net profit, you are left with $68,696. So that took a big bite out of your available cash. But if we looked at an S corporation alternative, then we're able to split that net profit between salary and between net profit or income. And let me show you how that works. We're going to pay income tax on the salary piece, which becomes your W-2 income or your earned income, as well as on the net profit of the business. But this time we're only going to pay FICA tax, or that self-employment tax we just talked about, only on the salary piece. So it's being paid on a much smaller piece of the income. That avoids the FICA or the SC tax on the remainder of the income or the net profit of that business. So let's look at our same $80,000 net profit example that we just talked about. And in this case, we had an $80,000 profit. We took a reasonable salary of $40,000, paid our FICA or our self-employment tax of $6,120. That left us with $73,880 as net income or net money in the bank. And by operating as an S Corp, we saved $5,184 in self-employment tax. Now you blow those numbers up to be a bigger set of numbers, and that $5,000 number starts growing exponentially. You heard me use the term reasonable salary just a minute ago. Well, reasonable salary is determined by the IRS. A lot of times you'll hear people talk about maybe I need to take 1/3 of the net profit as salary and 2/3 as income. I personally don't agree with that. I always have my clients allow me to run a reasonable compensation analysis for them. We use a third-party piece of software, and based on questions of what you do during the course of your average day, your average week, we're able to determine a reasonable salary. And then that is the number that we use. And we pay in the FICA tax based on that number, and we protect the rest of the business net income. Remembering back to those audit odds, when you operate in a partnership or an S Corp type environment, you've dropped the odds of being audited to just 0.5%, at least over the last few years. Now, if you're not already processing payroll for employees, then we need to do some steps to make this particular tax strategy work for you. Need to register your entity with the state, obtain an employer identification number or an EIN, and that's gotten from the IRS. We need to file an S Corp election form with the IRS and get their approval to be taxed that way. And then each quarter, you'll be filing a 941, which is a payroll tax form that goes to the IRS. You may end up filing some state unemployment to your state. You'll have to file some workers' comp premiums, whether it's monthly or quarterly or annual. That'll be up to your state. And then you'll be making some estimated tax payments as well to cover the net profit of the business that's not subject to withholding. At the end of the year, you'll issue some forms W-2 and W-3, and that's how you report your total salary to the federal government as well as to your state. You'll be filing a form 940 and reporting the federal unemployment tax and paying that in. And then for income tax purposes, you'll be filing a form 1120S and a state return for those states that require income taxes. And then there's some other minimal corporate formalities that need to be taken care of every single year. And that's a small price to pay to save thousands of dollars in SE tax or self-employment tax each year. Our fourth mistake that I see people make all the time is not having a retirement plan or being in the wrong retirement plan. You can see by my graph here that there are times when certain plans outperform other plans, and the most common are a SEP, a simple, and a 401k. Let's take a better look at each of those. So your SEP is a simplified employee pension plan. It is a turbocharged IRA. You can contribute up to 25% of the net profit of your business, up to a $66,000 maximum. But what's hard is if you have employees, whatever you contribute for yourself, you must contribute to those employees or on those employees' behalf as well. And so as soon as you start having employees, this plan becomes too expensive for you to offer and to be able to utilize. It is a plan that does not have any annual administrative fees, which is a nice thing for you. So then let's talk about a simple IRA. Possibly that might work better for you. This is a plan that works well for a business who's just getting started in retirement planning. It also is a turbocharged IRA. It allows you to deduct 100% of your salary up to $15,500. So this is assuming you were on salary or you have employees on salary and you're paying them payroll, not necessarily on salary. You're able to do a $3,500 catch-up contribution if you're over age 50. As an employer, you can match the funds of those who participate in the plan at 3%, or you can do a 2% profit sharing contribution for everybody in the company. There's no annual administrative costs on this plan, and this plan works well for companies who are not needing those higher deductions, but they're wanting to offer this to their employees and for their owners so they can get started on doing some retirement planning. The next step up our ladder is a 401k. It allows you to defer 100% of your wages up to $22,500. You're allowed a $6,500 catch-up contribution for people who are 50 and above. We have the choice of an employer match or profit sharing up to 25% of covered compensation. This brings us to a maximum of $66,000 for the employee and employer contributions for the year. Most 401ks allow loans and rollovers and hardship withdrawals, so they are a little more flexible than the other programs are. And this is a true qualified plan. It will have some administrative costs. It files a tax return every year. So there's some things here that you will not see in a SEP or in a simple. There are some variations to a 401k. There's a simple 401k, which is a sole or solo type plan. In this plan, you can defer 100% up to $15,500 with that same $3,500 catch up at age 50 that we saw in the simple plan. It has that similar employer match of 3% of those that participate or 2% profit sharing match and no annual administrative costs. Or we have a safe harbor 401k, and I see quite a few of these in with my clients. Doesn't have to be your sole plan. You can defer 100% of your wages up to $22,500. We have that same $6,500 catch-up contribution for those that are age 50 and above. The employer match can be 4% for those that participate or a profit-sharing match of just 3% for everybody. With this type of a plan versus the simple or some of the others, your employees can contribute more, you yourself can contribute more, you end up getting more paid into the plan. It does have some fairly simplified administrative pieces versus some of the other types of plans. Then with the final step up the ladder is a defined benefit plan. Defined benefit plans are better for older people. And older, you can start contributing around 45 or 50. And then your business needs to have considerable net profit to make this plan really work. So it allows you to determine how much money do I want to receive at retirement time, and then reverse engineer how much you need to contribute to get that in there. The other plans, we're all contributing how much do we want for a deduction today, and we'll get what we get, whatever it is at retirement time. Our number 5 item where I'm seeing missed opportunities and mistakes is missing family employment. This is always one of my favorite strategies because most home service businesses don't realize they can hire their kids to work in their business. The IRS says that child needs to be at least 7 years old, and that's pretty young. At 7 years old, what types of things can that child do around your business? Stop and think about it for a bit. There's some things they can do. You might have to get a little bit creative. Up to the standard deduction is tax-free. And then the next 11,000 is only taxed at the 10% bracket. We have to be careful because whatever we have this child do, they have to be able to do it safely. It has to be within their realm, their knowledge, their physical ability, that type of thing. And we have to pay them a reasonable wage. We have to make sure that we're not paying them more than we would pay somebody else in the general public to do that same position. Want to make sure you've got a written job description and that your child keeps a timesheet and that you issue a paycheck every pay period or whenever they've worked. So they are treated the same way as any other employee in your company. You need to have a bank account in your child's name so that we can put that payroll check into it and show that that money was deposited in their account. Now, one of the nicest things about, there's a couple really cool areas in this way, is you're able to pay for things that are after-tax deductions with what amounts to pre-tax income. One of my favorite things are during the summer when the kids want to go to all these camps, maybe it's horse camp, basketball camp, football camp, baseball camp, gymnastics camp, whatever it might be. If you've got your child working in your business, you can now take that money that you paid them for wages, which is pre-tax, and use it to pay a post or an after-tax item that's not deductible on your tax return. So those are nice little ways to fill in some tax saving strategies. But something I like even better than that is learning how you can make your child a tax-free millionaire. You can see by my chart that if you start contributing money for your child by the time they're age 16 or maybe even younger, because you've got them working in your business, they just need to have some earned income, which is what they're getting on their W-2 and then their payroll. If you start contributing to a Roth IRA at such an early age, By the time they hit retirement, they should have more than $2 million sitting in that account. The beauty currently of a Roth IRA is that the money that goes in there is not tax deductible. Therefore, it's not taxable when it's pulled out, provided it's been in there at least 5 years. And the earnings that it makes over the years is also not taxable under current tax law. Well, if we were to do that, and that IRA had a little over $2 million in it at today's tax rates, that would be a tax savings of over $437,000. That is pretty phenomenal, consider we started out young, put money in, and then through the power of compounding over that many years, it built to this really nice amount of money. Our next, number 6 on our list of tax mistakes, is missing various medical type expenses. Because so many people are not able to itemize their deductions anymore, they're not able to write off medical expenses. So let's see if we can come up with a way to do that for you. My number 1 plan is through a medical expense reimbursement plan, but it doesn't work for everybody. It works well if you're operating as a proprietorship or a single member LLC and you have a spouse. So you do have to have a spouse to make it work. And there, all we have to do is hire our spouse to work in the business, and we could potentially pay our spouse with being through the reimbursement of our medical expenses through our program. Now, if we're in a partnership entity, we can hire our spouse, but only if we're less than a 5% owner. If we operate as an S corporation entity, we're not able to make this one work because it doesn't work for shareholders who own more than 2%. If you're in a C corporation entity, all you have to do is hire yourself, and we can make this program work for you. It's a great way to get expenses reimbursed and take it as a business deduction. But remember, what you do for yourself, you have to do for the rest of your employees. Here's some eligibility requirements is you can exclude employees that are under 25 years of age if they work less than 35 hours a week or less than 9 months in the year, or if they have less than 3 years of service working for you. We can also exclude some they fall under the controlled group rules and the affiliated service groups. We'll talk about those at another time. Our benefits in this plan is you're able to reimburse medical expenses for self. So that would be your spouse potentially, and your spouse's spouse, which is you, and all of your dependents, which includes your family. So this is a great way to write off medical expenses and avoid that 7.5% floor that comes from your itemized deduction schedule, or maybe because you don't have enough deductions itemized, that's not even an issue and you just don't get to write off your medical expenses. It also potentially avoids some self-employment tax by reimbursing these costs out of your business. You can use your individual insurance, or it can be used to supplement insurance from an employer. Eligible expenses include major medical insurance, long-term care, Medicare or Medigap insurance, copays, deductibles, prescriptions, dental, vision, and chiropractic, braces, LASIK surgery, fertility, special schools, over-the-counter medications that are prescribed by a physician. There is a little bit of paperwork to make this type of a plan work. You need to have a written plan document, and the benefits that your spouse is receiving need to be reasonable in as far as a compensation amount goes. You want to make sure they're putting enough time in your business to make it reasonable. You need to document the payments, and there's an annual certification that needs to happen, and what we call a PCORI fee needs to be paid annually as well. A lot of times it's not possible to make this medical expense reimbursement plan work, and so then we turn to a health savings account. Can we utilize that in the business for you as the owner as well as for your employees? So a health savings account requires a high deductible health plan. Currently, the deductible needs to be at least $1,500 for individual coverage or $3,000 deductible for family coverage. A health savings account, you're able to contribute and deduct up to $3,850 if you're single, or $7,750 per year if you're married. Now, you don't have to spend all that money going into the account. That account can sit there and grow tax-free, just like a traditional IRA account would do. And you can have tax-free withdrawals to reimburse for your qualified medical expenses. So it works similar to an IRA in that it just sits out there and grows. You add money to it, you take money from it when you're reimbursing yourself for your medical expenses. Our next mistake that I see people making on a somewhat regular basis, not as much as I used to, but somewhat, is missing home office expenses. This one might be a little harder to do for home service businesses unless you're running your business out of your home. Your home office has to qualify by being the principal place of business where you do your administrative work. It has to be used exclusively and regularly, not just once in a while. It's where you do your administrative or your management activities of your trade or business. So if you have a building and you have an office in the building and that's where you work all day, every day, you may or may not be able to qualify for a home office because it says you have to have no other fixed location where you conduct substantial administrative or management activities of your trade or business. So you want to look at what are you doing in your main office versus your home office and see if we can make a home office qualify for you. If you make a home office qualify, then there's some ways to calculate some percentages. We're going to look at the number of rooms in your home or look at the square footage, and we're going to eliminate some common areas and just come down to here's the business piece of it. The deduction actually takes into account your mortgage interest and your property taxes. It picks up your utilities and security costs, cleaning, office furniture and decor, and then allows you to depreciate that portion of your home over 39 years. But the best part is that it increases your business mileage deduction. When you have a regular office or a shop where you go to actually run your business, from home to your office or home to your shop location is considered commute miles. So it is not deductible. But when we are able to make a home office work, then the minute we step foot outside our house, we are on a business miles. If we are on our way to see a customer or go out and bid a job or go take a look at a job or those types of things, we no longer have commute miles. And so that's probably one of the biggest reasons for wanting to have a home office is be able to reduce the commute miles. Now, if we don't want to go through the whole calculation of all these expenses, the IRS gives us a safe harbor amount of taking $5 per square foot of business use space. But you're probably wondering, what happens when I go to sell my house? What do I have to do at that point? Well, all we have to do is go in and recapture the depreciation that's been taken, and you're still able to keep your tax-free exclusion. And that tax-free exclusion is the one that says if you've lived in your home for 2 out of the last 5 years and you sell it, you're able to exclude up to $250,000 in gain if you're single or $500,000 in gain if you're married. So that's a pretty important deduction because it allows most of us to exclude a good portion, if not all, of the profit from the sale of our home. Our next most expensive tax mistake I see is not taking full advantage of car and truck expenses. Now, in home service businesses, I don't see this as much as I do in other types of clients, but that's still worth talking about. According to AAA in 2022, the cost to operate a small sedan was 52.13 cents per mile. A medium sedan was 64.54 cents per mile. A subcompact SUV was 58.78 cents per mile. A four-wheel drive SUV was 73.82 cents per mile. And a pickup was 85.54 cents per mile. Well, the 2023 mileage is 63.5 cents per mile. So you can see if you're driving a four-wheel drive SUV or a pickup, you are actually losing money, considerable money, if you're taking the standard mileage deduction. Now, most of you in the home service industry are operating with a fleet of vehicles. So you have multiple trucks and vans, and you're pretty good at getting them titled in the business name, depreciating them out on a depreciation schedule, and then picking up the actual costs of fuel and repairs, tires, insurance, all that type of stuff. And that generally in your industry results in a much bigger tax write-off. And so we want to take a look at that, but most of the time that will give you a much bigger tax write-off. Number 9, taking into account those business meals, making sure that we're not missing out on this as a deduction. Business meals can become deductible when we have a bona fide business discussion. This discussion might be with a customer or prospects, a referral source, a business colleague, or any of the above. Over the last 2 years, due to COVID, we've been able to write off 100% of those business meals, provided that you use the restaurant for it. Well, now we're back to our normal regular rules for 2023, where we'll be able to deduct 50% of the cost of that business meal. But I want you to stop and think about home entertainment. When's the last time, or how often, do you have people over to your home and you end up talking business with them? Maybe it's a group of investors or a organization, a trade organization that you belong to, or something along those lines, and you've got them at your home. So you want to make sure and keep really good records, because you can potentially write off the costs of that meal that you served at your home. How do you audit proof your meals deduction? Well, we want to make sure we've recorded these 5 pieces of information. How much was spent? That's right on the bottom of the receipt. When did you have the meal is also on the receipt. Where did you have it? Hopefully it's nice and clear on the receipt. If not, write down the restaurant name. What was the business purpose? Were we having a discussion? Was it a sales meeting? Was it a planning or a strategy meeting? What was the discussion for the meeting? And then what is the business relationship of the person you were meeting with? I like to also get the name on there in addition to the relationship, so that we've actually audit proofed our meal deduction, and we can take that as a bona fide business deduction. The final tax expense mistake that I see is that people, coming back around to the very beginning, don't realize that they need true tax planning. They think that they reach out to their tax preparer, and their tax preparer sends them off to go buy a piece of equipment or a vehicle or something along those lines, and they think that's tax planning. But you can see from all these pieces that we've walked through that tax planning encompasses so much more. And we've just barely touched the top of tax planning. There's so many other strategies out there that I love to do for larger type companies that have bigger profit amounts. Tax planning is so much fun because we get to actually take the IRS code and turn that into deductions for you. And so I think it's very rewarding as I get to work with people all across the US and do tax planning with them. But one of the things we want to have when we're doing true tax planning is a written tax plan. We want that tax plan to encompass not just your business, but your family, your home, and any jobs or anything that you might have and your spouse might have. We wanted to include your business income and any investments that you have, whether they're investments in financial products or investments in rental real estate, whatever it might be. We want to take time to sit down and review your last 2 to 3 years' income tax returns. Quite often, I find missed opportunities, and we're able to go in and amend those tax returns and recoup that money. So this is such an important piece, and it's probably the top most expensive mistake that I see, is that you just don't realize that you can actually plan your way to a lower tax liability. So this is a true profit leak. If I'm staying in the vein of all the other podcast episodes that we've done, we are out looking for profit leaks. We're intentionally looking for profit leaks. And this is a big profit leak when we're overpaying our taxes. So we don't want to be overpaying our taxes. We want to pay our fair share, but we certainly don't want to leave the IRS a big tip. And so now I'm going to say that's a wrap for this episode of the Profitable Home Services Podcast. Remember, it's not how much money you make, it's how much you keep. If you'd like a free digital copy of my book, Your Path to Profits book, which shares 9 profit boosting tactics that will transform your service business, head on over to yourpathtoprofitsbooks.com. If you would like a copy of the book that this information came from, the 10 most expensive mistakes that cost a home service business thousands, you can also go to my website at www.profitcoachforyou.com, and in the contact us form, or there's a page on there with all the different books that I've written, you can reach out and order a copy of that book. As always, thank you again for listening, for being part of our family and being part of our podcast episode. Thank you and have a great day.